Let's go ahead and get started. And before we begin, I want to give some housekeeping items. For those of you that are going to be wanting CPE for today's session, we'll offer 1 hour. There'll be 3 poll questions that you'll need to take. So keep an eye out for those and respond to those, and we'll be sending you your CPE certificates in the coming days. Also wanted to let you know, for those of you who don't know me, I'm Jerry Murphy. I'm with Sikich and the leader of our manufacturer distribution vertical. Anyone not familiar with our firm, we're a multidisciplinary professional services firm specializing in tax, technology, audit, accounting, and advisory services, and rank one of the largest CPA firms in the US. Welcome to our 2025 economic update for manufacturers with Michael Weidokal. Many of you see our pulse survey that comes out several times a year, and unsurprisingly, inflation was at the top of the executives who took our pulse surveys mind in 2024. And with proposed tariffs and the new administration, I know we're all looking forward to hearing what Michael has to say about all of that this morning, as well as a number of other topics. I'm going to introduce Michael, who's returning for the 4th time presenting for us. He's the president and founder of International Strategic Analysis and a leading provider of economic forecasting, international market intelligence, and geopolitical analysis. Thanks for being here today, Michael, and I'm going to go ahead and let you take it from here. Thank you.
Thank you. Good morning, everybody. I'm excited to have the opportunity to speak with you for the 4th consecutive year. Obviously, there's been a lot going on in the world over those 4 years, and this year has proven to be no exception to that. 2025 has begun with what could best be described as a very uncertain and somewhat chaotic start. And there's a lot of changes and developments in the market here in the US and around the world that have really thrown a lot of businesses for a loop. So let's get started. We've got a lot to talk about. We're going to talk about where the economy is right now here in March 2025, where the economy is going, hopefully, in the next couple of years. We're going to look at some big picture issues that are driving, or at least are behind, a lot of these changes and a lot of this uncertainty that we see. That includes changes in our population, rising levels of political risk, rapid technological change, and a changing environment. We'll then look at the longer term outlook for the US and global economies, and then we'll talk a little bit about how your businesses can prepare to succeed in what is undoubtedly a very challenging world. You've heard about me. My name is Michael Weidokal. I run the firm ISA International Strategic Analysis. I am also the author of the uplifting book, The Coming Decline, A World Without Economic Growth. If you are in need of some inspiration, or at least have problems sleeping, this would certainly be a book right up your alley. Again, ISA, we do economic forecasting, political forecasting. We publish a number of reports and updates for our clients around the world. We also provide a number of different advisory services for a wide range of clients around the world. Without further ado, let's get to our first poll question.
Thank you. Thank you, Michael. To begin our CPE process, we've got the first poll question. How prepared is your company to navigate economic uncertainty in 2025? Give folks about a half a minute here. Go ahead and answer. Those answers are very prepared, somewhat prepared, not very prepared, zero preparation. It looks like most everyone at 82%, I'm sorry, 77%, 82 respondents indicated that they are somewhat prepared and adjusting as needed. Not surprising, as much as things have changed over the last several weeks and months. Michael, any thoughts on is that meeting your expectations?
It is, because we've had so much uncertainty, really going back to the global financial crisis, or for most of the 21st century. So companies have had already to deal with what have been some major economic changing events, market changing events. So I think companies, because of this experience with COVID, with the financial crisis, 9/11, et cetera, have are probably better prepared today than they would have been, a couple decades ago when we were living through a much different world. Shall I continue? Okay, let's go. All right. Where are we now with the global economy? The global economy, of course, has been undergoing a great deal of change. And one thing that we've noticed this year is a dramatic decline in confidence levels, particularly among consumers in the United States. Confidence levels have been relatively low in recent years, despite the fact that the economy, as you'll see, did not perform that badly. Of course, a lot of that has to do with rising levels, or at least higher levels of inflation. But this is something to watch very closely. Businesses and consumers and investors do not like uncertainty, and uncertainty leads to hesitation when it comes to spending, particularly on major projects. And the longer the uncertainty lasts, and we are living at a time of a great deal of uncertainty, the bigger the impact is going to be on confidence levels, and then the bigger the impact will be on the economy. So that's what we're seeing right now, is a definite lack of confidence among businesses and consumers in the state of the economy. So what is the state of the economy? This chart here shows global economic growth rates over the last 10 years. What's important to note is that prior to COVID, the global economy grew by about 3.6% per year from between the financial crisis and COVID. That was a pretty good result. Over the last 2 years, the global economy has grown 3.2%. That doesn't sound like a big decline. It's not, but nevertheless, it's still 10 to 15% slower than where we were before COVID. Imagine your business was generating 10 to 15% less profits than it was in previous years. Certainly, there would be some concern, there would be some need for adjustment. That's what we're looking at with the global economy. And one of the big reasons for this is that growth has been concentrated in a small number of countries. Most major economies in recent years have been struggling with either the inability to generate growth or with an extreme level of volatility. If we look at the United States over the last 10 years, the chart here doesn't look all that bad. The US economy has grown by almost 3% in each of the last 2 years. This is significantly higher than most economists expected, and it's certainly higher than just about every other rich economy in the world. Why is this? Well, the US has a very high level of economic competitiveness, and it has a very strong presence in high growth sectors of the economy. You look at a lot of the sectors that are driving growth, whether it's professional services, high tech, healthcare, the US has a very strong presence in each of those sectors. And that's allowed the US economy to generate significant levels of growth. So did immigration, quite frankly. We could have been dealing with even more severe labor shortages than we had it not been for an influx of workers into the US economy in recent years. So you take that high degree of competitiveness, the presence in high growth sectors, and a relative availability of a workforce, and you end up doing relatively well. Let's contrast that with Europe, for example. This is the Eurozone, so the countries that use the euro as their currency. You can see there the economy has done much worse in recent years, growing by less than 1% in each of the last 2 years. Most of this growth has been concentrated in tourism-heavy economies in the South, or in manufacturing-heavy economies in Central Europe. The big economies have struggled, most notably Germany. Germany's economy has shrunk for 2 consecutive years. In fact, Germany's economy today is smaller than it was in 2019. So this growth in Europe has not been in place as it has been in place in the United States. Why is that? A lower level of competitiveness and an over-reliance upon slow growth sectors of the economy. Europe simply does not have as big of a presence in many of those high growth sectors of the economy. So this chart shows the average economic growth rates for the world's largest developed economies over the last 5 years, and the United States is on top with 2.4% per year. That's significantly higher than Europe, which is closer to 1% per year, and you can see Japan down there at about 0.4% per year. Now, economic growth rates in the world's rich countries are slower now than they were in previous decades, but when you compare the US to its peers, it's been generating a pretty high level of growth in comparison with those other economies. What about emerging markets? Let's look at China. China's economy grew by 5% last year. That's half of what China's economy used to do. Remember, for a 30-year period, China's economy grew by 10% per year. And even in the years prior to COVID, it was still growing at 7% per year. Last year, China had to enact a massive amount of economic stimulus measures just to get to 5%. And why is China not growing as fast as it used to? Its domestic market is significantly weaker. China's real estate sector, other sectors of the economy have massive levels of debt. This has dramatically reduced consumer confidence in China and has resulted in China's economy growing slower. So where did the growth come from? It still came from manufactured exports, despite all of the efforts at decoupling from China and at reshoring in other parts of the world. China still is manufacturing a large amount of the world's manufactured goods. And this has been what has kept the economy in China from falling even further, because quite frankly, the domestic market in China is extremely weak at the moment. So what about India? India, the other great emerging market. India's population last year overtook China. So India is now the world's most populous country with a little more than 1.4 billion people living inside its borders. Its economy has been performing better in recent years, but it's also been highly volatile. It slowed in the second half of last year. And quite frankly, India is never going to get to the 10% economic growth rates that China did in the past. Still, with its massive population, with an increasing amount of investment, particularly in the manufacturing sector, going into India, it's going to play a more and more significant role in the global economy. So how have emerging markets done in comparison over the last 5 years? For the first time, I've been doing a presentation like this for more than 20 years. This is the first time a country on top of this chart has not been from South or East Asia. Turkey's economy, despite all of its inflation and all of its currency problems and its political uncertainty that we're seeing at the moment, has been the world's fastest growing large emerging market over the last 5 years, a little more than 5% per year. Southeast Asia, of course, remains a major center of growth. This is a region where a lot of manufacturing investment is going. The decoupling from China, when manufacturers are looking at reducing their dependence upon China as a source for manufactured goods, as a key component of their supply chains, they're looking increasingly at Southeast Asia, because Southeast Asia has a large workforce, an affordable workforce, an increasingly well-developed infrastructure, and that's allowed Southeast Asia to generate relatively high rates of growth. Outside of Asia, we haven't seen as much growth. Africa, despite its rapid population growth, is growing less than 3% per year. Latin America growing less than 2% per year over the last 5 years. And interestingly, Mexico has been the slowest growing large emerging market in the world during this period. There's been a lot of talk about the manufacturing investment and going into Mexico, but Mexico's economy has been performing extremely poorly. And when there was an expectation that Mexico's economy would take off as more and more manufacturing went there, that has not been the case. As you can see from that chart, Mexico's economy barely growing more than 1% per year over the last 5 years. So where has global growth been coming from? It's been coming, quite frankly, from the United States. I think a lot of people 10 years ago would have been surprised if this was the outcome for this chart, if they could see 10 years into the future. It was expected that China would be the leading driver of global growth and that emerging markets would be playing a greater role. But quite frankly, the United States remained the key contributor to the global economy and its additional output over the past decade. Where does it come from by sector? Now, this shows economic growth rates by sector in the United States economy. And it's changed quite a bit. One big change has been the decline in oil, gas, and mining. That has to do with the fact simply that oil prices were quite high at the beginning of 2022, and they've fallen since then, and that's resulted in that decline. But look at the sectors that are growing. A lot of them have to do with consumer spending and professional services. No surprise there. The United States has some of the wealthiest consumers in the world. They also have consumers that don't like to save. So you combine the two and you get very strong growth in sectors like arts and leisure, education, and real estate. The healthcare sector is the one sector that people ask me often, which sector is guaranteed to grow in the future? Clearly, it's the healthcare sector. Our population is growing older and more in need of healthcare. That's a sector guaranteed to generate growth. You can see some of our traditional sectors have not generated all that much growth in recent years. Manufacturing growing by a little bit less than 5%, agriculture declining, and as I mentioned, the oil, gas, and mining sector declining sharply during that period. It's been a year of political change. Around the world, people have been going to the polls and in many cases voting for dramatic change. In fact, over the last 12 months, people in countries with a population of more than 4 billion people have gone to the polls. So it has been a year of dramatic political change, not just in the United States, but we've seen in Europe, in Asia, and Latin America, major changes in government, major changes in economic policy, security policy, all as a result of some of the political changes that are underway in the world. And we'll talk about some of those in a little more detail. Of course, in the United States, we had a very important election last November. Donald Trump won the election by 1.5% in the popular vote, won it fairly clearly in the electoral college, of course, by sweeping the swing states. The Republicans quite simply controlled the narrative in this election. The issues that dominated this election were inflation, immigration, and the Republicans were able to use their domination of the narrative in this election to not only win the presidency, but to have control of both houses of the Congress as well. And it hasn't been very long since the Trump administration has been in place, but we've already seen some dramatic policy changes since January 20th. In terms of domestic policy, the most notable change, of course, has been the efforts by the Trump administration and the DOJ to shrink the size of the federal government. We're seeing dramatic cuts in many key departments, federal departments across the United States. This is expected to continue as we go forward. There's been a lot of missteps, quite clearly. In my opinion, this is something that needs to be done in a surgical way. Instead, it looks like it's being done with a sledgehammer. But nevertheless, this is a clear trend. We are going to see more cuts to certain departments in the federal government as the Trump administration tries to reduce the size of the deficit and the debt in the United States. Now, we'll talk about how feasible that is, because so far a lot of the efforts to reduce spending have been cosmetic at best and will have a small impact. There are some areas that would need to be cut much more significantly for this to have a major impact on our debt and deficit levels. We're also seeing major changes in foreign policy. We've seen an effort to bring an end to the war between Russia and Ukraine, with the Trump administration openly siding with Russia on this in this conflict. This remains to be seen if there'll be any progress made. So far, there's been very little. There was a Black Sea ceasefire, a naval ceasefire announced yesterday, but even that looks a little bit precarious due to Russia's demands to adhere to the ceasefire, and the conflict there goes on. We've seen the conflicts in the Middle East resume. The war in Gaza has restarted in recent days. We've seen the potential for the war between Israel and Hezbollah to restart. We have a new government in Syria as the Assad regime was overthrown. So major changes in the Eastern Mediterranean as well. Environmental policy, we've seen significant changes there, and of course trade policy. And we're going to get into more detail on trade policy changes in the coming slides. One thing I would note, there's been an effort to deliberately weaken the US dollar by the Trump administration. Now, the dollar has been strong internationally since 2014. We're in a period of extreme dollar strength, which has been in place for a long time. And this has had a negative impact on exporters from the United States. Our currency has been very strong, resulting in higher cost levels for US manufacturers and US exporters. And the Trump administration is attempting to change that. But at the same time, where do investors typically go when there's a lot of uncertainty in the world? They like to invest in the US dollar. So I think that will temper any further decline in the dollar in the months ahead. There's a lot of geopolitical risk in the world. I've never had Greenland on any of my geopolitical risk slides going back to the early 21st century, but it's there now. There's a lot. The point is, there's a lot of geopolitical risk in the world right now, adding to this level of uncertainty. I mentioned the conflict in Ukraine, the conflicts in the Middle East. We have major conflicts underway across Africa. We have a lot of flashpoints, which we'll talk about, which have the potential to further destabilize the global economy in the years ahead. We have tariffs. We have a number of tariffs that have been put in place. famously the 25% tariffs that were imposed on Canada and Mexico, and the 20% additional tariffs that were imposed on China. There's also been tariffs on steel and aluminum imports, which you're well aware of. This has led to retaliatory tariffs against US imports in many of these markets. Some of these retaliations have been postponed or at least delayed. Others have been already implemented. That is something we see likely to continue should the Trump administration decide to put tariffs on more countries going forward. Now, in some cases, these tariffs are more of a negotiating ploy. I do believe that the tariffs in place on Canada and Mexico could be lifted this year should there be some sort of deal reached. They could be reduced as well. It remains to be seen. The tariffs on China are here to stay, and there's a real likelihood that more tariffs can be put in place. Why use tariffs? This is why is the Trump administration so in love with tariffs? One reason, of course, is decoupling. This is particularly aimed at China in reducing the dependence that many US manufacturers have on supply chains that are largely based in China. This is here to stay. This is certainly a trend. This was also pursued in many respects by the Biden administration as well as the Trump administration. This trend is here to stay. The US and other, not just the US, but other countries as well, will continue to try and decouple their economies from China. And so tariffs in place on China are likely to remain and new tariffs are likely to be implemented. Rebalancing. Now, we all know President Trump's favorite statistic is the trade balance. And he cares more about what the US's trade balance is with individual countries than just about any other statistic out there. Can tariffs rebalance trade? Probably not so much. Again, US consumers are among the best paid in the world with some of the lowest savings rates in the world. US consumers are going to spend. That makes it extremely difficult to maintain a trade balance with countries that have much lower wages and much higher savings rates. So this is one where I think we may see a tiny impact. We did not see, for example, much of an impact at all on the tariffs that were put in place during the first Trump administration. And of course, were maintained by the Biden administration. They had almost no impact on balancing trade with the US's leading trade partners. And we don't expect them to have a major impact in this regard, in this case. So while decoupling, yes, there could be some impact, rebalancing, very little. Negotiating, again, I mentioned this is also a very popular reason why the Trump administration likes tariffs. It will use the vast size of the US market and its 350 million relatively wealthy consumers to negotiate favorable trade or border security deals with its trade partners around the world. This is something that will certainly continue throughout the next 4 years. The last one, probably the least likely to have any impact, is funding. And I, in fact, recently had a debate with the CEO of a US beer company who believed that this was going to be the way the US government would fund itself going forward. It's absolutely not possible. Their argument that's being used by some people who like this argument is that, well, we did it in 1812. Well, yeah, the government in the US barely spent anything in 1812. At best, the tariffs that we've imposed could generate revenues of maybe around $250 billion. And as you know, that is only a tiny, tiny fraction of US public spending. In fact, we spent more than $1 trillion just on interest on our debt last year alone. So funding tariffs will in no way, shape, or form be able to fund the US government. This, of course, has raised fears of a global trade war. The risk is that as the US imposes tariffs on its foreign partners, these countries will seek to offset losses in exports to the United States by exporting more to other countries. And those countries will have no choice but to impact tariffs of their own to protect key sectors of their economy. And that is something I think is very likely to occur, particularly as China's domestic market remains weak. It is going to try and export its way to continue growing. And that is going to concern European countries, Latin American countries, other countries in Asia. And we could see what is now a relatively localized trade war become a global trade war. And that would obviously be bad news for the global economy. Other economic issues we're dealing with, obviously inflation. Inflation has come down from where it was 3 years ago, but nevertheless, it remains much too high for comfort. And a lot of this inflation remains focused on cost of living related inflation. The big, let's say, the big exception to this rule has been China. China is dealing with deflation. China's inflation rate at the moment is minus 0.7%. Deflation is very bad news for an economy. Japan suffered from it for 30 years. It is extremely hard to get out of, and it really dampens economic growth prospects. And that's something China is facing very severely at the moment. And because inflation in most parts of the world is lingering, interest rates are not coming down as fast as had been hoped. The US is now expected to carry out only 2 interest rate cuts this year. It had been expected to carry out 3 or 4. And should inflation rates remain higher than expected in the months ahead, there may be no more interest rate cuts in the United States. It really remains to be seen in which direction inflation goes going forward. For many countries, labor shortages or the ability to match labor with available jobs it remains extremely difficult. In a period of uncertainty like we have now, you would expect unemployment in the United States, for example, to be significantly higher, but it's only 4.1%. Imagine if we had this level of uncertainty in the 1980s, the unemployment rate undoubtedly would be in the 7, 8, 9% range. Because our working age population is stagnating, because we're having problems matching available labor with available jobs, our unemployment rate sits at barely above 4%. So we've had an uneven global recovery. We have fewer drivers of economic growth in the world, and we have concerns about inflation and deflation related to China continuing. That's where we are now. Where will we be going? But first, before we get to that, let's have our second poll question.
Thank you, Michael. Second poll question for CPE today is, how concerned are you with the impact of proposed tariffs will have on your business on a scale of 1 to 5? 1 being not concerned and 5 being extremely concerned. This one I'm very interested in seeing how our audience responds.
Yeah, I'm curious what the results will be here.
It's actually turning out to be a little bit more even between 2 and 4 than I would have expected. And I think that might be a fairly good sign.
Yeah.
What do you think, Michael?
I think that reflects that there's an expectation that some of these tariffs may be temporary, particularly the ones on Canada and Mexico, because should those linger,
Sure.
major manufacturers would have significant concern. But I do think there's an expectation that in some cases this is a negotiating ploy. So that's what I'm hearing in a lot of the speeches that I give, and I've been speaking around the world in recent months, and that's kind of consistent with what I've seen, is that there's still an expectation that a lot of these tariffs will be negotiated either away or downwards in the months ahead. Okay, let's move on then. So what is the outlook now for the next couple of years for the global economy? Well, we're going to talk about where inflation rates are expected to go. We expect inflation to remain somewhat sticky over the near term. China is going to continue to deal with deflation, some other economies as well. But we do expect inflation to slowly trend downwards beginning either the latter part of this year or into 2026. And this is going to it's going to delay interest rate cuts, but we do expect them to resume at some point later in this year, early next year. And of course, labor shortages undoubtedly are going to persist. This shows our global economic growth forecast for the next 3 years. We expect the global economy to slow a little bit this year to 3% and to fall a little bit below 3% in the coming years. We'll show why in a second. Clearly, uncertainty about global trade has dampened expectations for growth over the near term. And there's a bigger fear of a larger than expected global slowdown in the coming years because of this uncertainty. The longer this uncertainty lasts, the more delays it causes in consumer and business and investor confidence recovery, the bigger the impact will be on the economy. Now, the US economy is expected to slow significantly. We've reduced our growth forecast from, it was at 2.6% at the end of last year. It's down to 1.9% for 2025. The Federal Reserve just reduced their growth forecast down to 1.7%. And in fact, the threat of a recession over the near term in the US has risen substantially. Most economists pin the chances of a recession now at between 30 and 40%, up from about 5 or 10% just a couple months ago. So again, this is a product of the uncertainty. And even a lot of vociferous supporters of the Trump administration are really pushing the Trump administration to be clearer about their economic strategy at the moment. The mixed signals coming out of the White House have really caused a lot of consternation. I'm seeing this repeatedly in my speeches, even in very pro-Trump industries or pro-Trump parts of the country. There's a frustration at the lack of clarity within the message and a lack of consistency in the message with conflicting reports coming out almost on a daily basis. So there's this call for a reduction in uncertainty, and that's causing this uncertainty, and that's resulting in this downgrade in our economic growth forecast for the US over the next couple of years. Now, the US still has its strong position in key industries. It still has a high degree of economic competitiveness. And in my judgment, this is going to prevent a significant downturn, meaning an almost no growth over the coming year. But nevertheless, this uncertainty is going to have a dampening effect on our near-term economic outlook. Europe, again, it's going to be a difficult period over the next few years, growth averaging just about 1% over the next 3 years. This is because the largest economies in the region are struggling to grow. And you can see from this chart, the US no longer on top, at least as far as our forecast for the next 3 years are concerned, but near the top, growing at 2% per year over the next 3 years. Europe down at about 1%, Japan a little bit below 1%. As far as China is concerned, China's government just came out with a growth target of 5% again. They are pumping a ton of money into the economy to try and reach this target. But nevertheless, the downwards pressure on the Chinese economy right now is substantial. A lot of it has to do with not just the trade war concerns, but China's domestic market and the fact that its population has been shrinking for 3 consecutive years and is shrinking at an ever quickening pace as we go forward. So as far as emerging markets, no surprise, Asia will remain the key driver of growth. South Asia and Southeast Asia in particular. China will grow by just a little more than 4% per year during this period. We do have a little bit improved outlook for some other emerging regions. Africa is expected to grow faster. Latin America, still not great results, but better than where it has been in recent years. Where's the growth going to come from by sector? Clearly, sectors like artificial intelligence, a lot of tech sectors are going to drive a lot of growth going forward. Healthcare, as I mentioned, is a big one. Energy, and we're going to talk about this in a little bit, a huge growth opportunity as demand for energy around the world is booming for 2 reasons, really. 1, emerging market demand is growing rapidly. 2, demand from the tech sector is growing rapidly. And that's going to lead to a huge amount of investment in energy infrastructure in the coming years. That's going to provide a lot of opportunities for growth. Another one to look at is defense. Defense spending is going up significantly in many parts of the world. As just geopolitical risk rises, we're seeing major defense spending increases in Asia, in Europe, in other parts of the world. So the defense sector also has an opportunity to grow significantly in the coming years. The US will remain the largest driver of growth, but barely over the next 3 years. And that's more to do with there's just not many other opportunities for fast economic growth outside of Asia's emerging markets at the moment. Europe is going to remain relatively stagnant. Japan's going to remain stagnant. Other emerging markets are still way too small to contribute a lot of growth. There's a big concern that should the US economy really fall on hard times over the next couple of years, that it could bring down the entire global economy, because the global economy, as you've seen, has been very dependent upon the US market to generate a lot of growth in recent years. Of course, there's the fear of a trade war. We talk about which countries are dependent upon the US export market. Obviously, Canada and Mexico, where more than 75% of their exports go to, but other economies as well. The US remains a sizable market for their exports. Geopolitical risk will remain high. The big thing to watch going forward is going to be the relationship between the United States and China. China clearly is involved in a number of very dangerous flashpoints, most notably Taiwan, a conflict which could involve the United States and others. You have the South China Sea, you have the relationship between China and India. Really, this balance between Washington and Beijing over the next couple of years is going to go a long way to determining global security in the future. So global trade, one thing that's interesting to note as we look at global trade, the US economy, while it's been growing faster than every other large developed economy in the world, has generated less export growth than any large economy in the world over the past decade. The US's success over the last decade has been driven by its domestic market, particularly consumer spending. The US has not generated a lot of export growth because, one, US manufacturers are often focused on the US market, and the US dollar has been very strong, reducing the competitiveness in international markets of US manufacturers. So this also gives the US confidence when it goes into trade negotiations with other countries, because the US can generate economic growth without needing to export. That is something that's not the case for economies like Japan, Germany, Italy, or Mexico, countries that need to export to generate economic growth. The US is not in that precarious position. The one thing the US has been doing very well, and it's been a focus of both the Trump and Biden administrations, has been attracting foreign investment into the country. And we're seeing this this reshoring, this nearshoring trend really take root particularly in the United States. The United States over the last 10 years has attracted $3 trillion of foreign investment. That's more than double any other country in the world. China, which is second, has seen its foreign investment, in contrast, fall significantly over the last 2 years. So again, this attractiveness of the US market will continue to attract foreign investment into the United States, no matter what the political situation is or the level of uncertainty. Companies around the world know that they need to have a presence in the United States if they want to grow. And this has resulted in a surge of foreign investment coming into the US. So what are we looking at over the next couple of years? We are forecasting a gradual global economic slowdown, but risk levels will remain very high, and this will continue to lead to the threat of a even more significant downturn. The possibility will be in place. Growth, will remain pretty uneven in the coming years, both by country and by industry. So there's four big trends that are driving a lot of these changes, and I just want to touch upon each of those in this presentation. One of those is a changing population, and this change in population is being driven by the fact that birth rates around the world continue to fall. The birth rate in the United States has fallen to 1.66. That means the average woman in the US now has 1.66 babies in her lifetime. In a country like South Korea, it's 0.7. In China, it's down to about 1, and it's falling. It's continuing the trend downwards. People are having, quite simply, less babies today. And what's the result? It's changing the dynamics and the structure of the global population. Nowhere is this more noticeable than among the world's youth population. In previous years, the world's youth population rose relatively quickly, but it's been falling, and now, in fact, it's declining. The number of people under the age of 18 in the United States is actually forecast to fall slightly over the next 25 years. This is causing huge problems for industries and sectors of the economy that are dependent upon young people. Think about education, the university sector in the United States, all of these sectors of the economy that need young people to grow. They're in big trouble. And they're particularly in big trouble in places like India, Europe, or in China. In China, over the next 25 years, the number of people under the age of 18 is forecast to shrink by more than 40%. Think about that for a second. If you are a company focusing on Chinese young consumers, about what is happening to your market. Now, the sector of the population that drives economic growth is the working age population between the ages of 18 and 65, and that had been growing rapidly around much of the world, but it had been slowing. It's declined in Europe in recent years. It's slowing in China. Look what's going to happen in the next 25 years. In the United States, the number of people in the working age population is only going to increase by about 5%. Not much at all. In Europe, it's going to decline by close to 15%. In China, it's going to decline by more than 20%. This is a big problem. This has been what has been driving global economic growth since the Industrial Revolution. The ever increasing number of available workers, that will no longer be in place. Now, some people will argue, well, we'll just use automation. We don't need as many workers. True, in some industries, there's no doubt that will have an impact, but we won't be able to replace these as consumers. And this is the largest segment of the population in terms of consumer spending. And robots are not going to consume anything besides energy, quite frankly. And that is going to be a huge problem economically. Now, where is the population growing? It's growing in the share of the population that is over the age of 65. Right now, there's about 800 million people in the world over the age of 65. By the year 2050, it will be 1.6 billion. It will double. And we need to make these people more productive. That means one day raising retirement ages, allowing people to work longer into their lives. Otherwise, there's no way our government finances will be able to manage this growing segment of the population that is no longer allowed or enabled to be productive. If the government wants to truly cut government spending and improve government finances, it has to do something about this issue. Population is not just changing by age, it's changing by characteristics and attitudes. The world looks and speaks and believes differently than in the past. This brings positives in terms of new ideas into the economy. Think about how many successful new US businesses have been founded by immigrants or the sons and daughters of immigrants, but it also brings strains on society as well, as we've seen particularly politically in many parts of the world in recent years. The world also looks and thinks differently. This is having a big impact both on consumption and on the labor force. Consumption preferences have dramatically impacted many industries. Working preferences have changed dramatically as well, posing huge challenges for businesses who try to find and retain quality workers. So the world is not just changing in terms of its age, it's changing in terms of its other characteristics as well. So what does this mean for the economy? Demographic decline is bad news for the economy. We have an older population that we need to make more productive. We have a population that has different priorities than in the past. Another trend we've seen is rising levels of political risk. We're seeing rising levels of extremism, both on the far right and the far left. This has resulted in a shrinking of the political center, and this has made it very difficult for opposite sides of the political spectrum to work together. And some of these major challenges we're going to face in the future, we're now doing it with increasingly divided political systems. Politics is also fragmenting into special interest groups. We see this chart just shows the makeup of the Dutch parliament, where there's 17 political parties in place at the moment. Single issue politics is becoming a very consistent and disturbing trend where more and more voters are increasingly focused on a single issue to decide their voting preferences. And that again makes it very hard for competing political groups or political parties to work together, and it's eroding confidence in democracy. Geopolitical risk is not going to go away. It's in fact likely to rise in the coming years, particularly if the US becomes more isolationist. The overwhelming power of the US geopolitically in the decades after the Second World War led to a relative degree of global stability. Sure, there were conflicts around the world and in other uncertainty, but when you compare where we've been in recent decades to where we were in the past, the world has been a relatively stable place. That would no longer be the case should the US become more and more isolationist. This political uncertainty and these geopolitical trends are leading to more and more localization and reshoring. The era of globalization is coming to an end. That doesn't mean that we're not going to have globalized supply chains and we're not going to be selling our products around the world, but the era of investing in full-scale globalization is coming to an end. In its place, we're seeing something more like regionalization, where leading powers dominate specific regions, more like we saw in the past. Now, there are challenges to localization and reshoring. Labor shortages are one, infrastructure deficiencies are another, but nevertheless, this is a trend we expect to continue. So what does this mean for the economy? It is a serious threat to the economy. It adds to uncertainty, it adds to risk, and that is bad news in any way you look at it for the economy. Both and domestic political risk is rising. This is threatening to destabilize many of the world's leading economies, and the threat of great power conflict remains significant as we go forward. Now, rapid technological change is another big change we're dealing with. Technological change is happening at a faster pace than ever before. It used to take a couple generations for a new technology to be adapted. Today, it takes a couple years. The pace of technological change is leaving many companies and many industries behind because it is so fast and happening so rapidly. And what is perhaps disconcerting is that we're not far away from a future where technological change may no longer be driven by humans. It might be driven by AI and automation. And that is also concerning. That will just lead to an ever increasing pace of technological change. On one hand, the world has moved online. This has been the big technological change of the last couple decades. The average person, not the average teenage daughter like mine, but the average person spends 7 hours per day online. And the global e-commerce market is now worth $6 trillion. It would be the world's third largest economy on its own. And for much of the world, they're living a large share of their lives online. Now, the big change in the last couple of years has been the spread of artificial intelligence. That chart, and you'll all be getting a copy of this presentation, so don't worry if you can't read the chart as I go through these relatively quickly. This shows the vulnerability of certain jobs to AI. And right there in the most vulnerable section is economists. So I'm pretty concerned. I might be handing out my resume to everybody as AI threatens to take away the jobs of economists. And that it's going to transform the workplace in many ways. Many jobs, particularly those jobs that do not involve using your hands or do not involve client-facing work, will be in jeopardy going forward. And the big thing that's coming, and I speak at a lot of conferences, I see a lot of AI experts speaking because I always stick around to listen to them. The next big thing, of course, and we're seeing it rolled out slowly now, are AI agents. And this will have a transformative impact both on the economy and on the labor force. And we need higher productivity, quite frankly. So AI does have, it's not just doom and gloom. We need to generate higher rates of productivity growth if we want to generate higher rates of economic growth. And maybe, just maybe, AI will allow us to do that. So clearly, tech industries are going to drive a lot of growth. For those businesses that are not up to speed with these technological changes, they need to get up to speed now, or they risk being left behind. And hopefully, this will lead to higher levels of productivity because our population is going to shrink. Trade and investment growth is going to remain relatively weak. The only way we're going to grow as an economy is through higher levels of productivity. Finally, the last major trend I want to talk about is the environment. Clearly, we're dealing with a changing climate. This is the average, that chart shows the average temperature per year going back to the late 19th century. The trend is unmistakable. We're seeing temperatures rise consistently, and even while it snowed outside of my window this morning here in Ohio, it's clear that we've seen an upswing in global temperatures. And this climate change is having an increasing impact on key economies around the region, around the world. It's leading to higher levels of natural disaster risk. You've seen what happened in recent months in LA, in North Carolina, in Spain, and many other parts of the world. Natural disaster risk is rising substantially. This has led to an increasing focus on sustainability. Renewable sources of energy are going to be the leading source of global energy consumption within the next couple of years. It's already in some regions become the leading source of energy consumption, but it will in many other parts of the world as we go forward. And there's going to be a huge increase in demand for energy. Now, in North America, energy demand has been relatively flat. In Europe, it's been declining. But look what's happened in Asia, in the Asia Pacific region in the 21st century. This is going to happen as well in Africa, in Latin America, in parts of the Middle East as well. And it's not just happening in regions, it's happening now by industry as well. This is a lot of this has to do with the tech sector and the huge amount of demand for energy in the tech sector. So not only are labor shortages going to be a constraint on economic growth, energy shortages could be as well. And it's going to lead to diverging competitiveness. Those regions that have energy supplies are going to have a huge competitive advantage over those that don't. So now we have time for our final poll question of the day. I'll let that be asked now.
Thank you, everyone. Final poll question today. What is your biggest challenge in planning for growth in 2025? Access to capital, adapting to new regulations, finding and retaining skilled labor, implementing new technology and automation, or other? Give folks just another minute here to answer. I'm not really too surprised that finding and retaining skilled labor continues to be a real challenge. Michael, you mentioned that earlier,
Yeah.
and our poll surveys throughout the last several years have found very similar results.
Yes, that surprises me not at all. I would have said that would be number one, and I can't see the results from here, but I would guess technology might be number two. But
It is.
yeah,
It is. Implementing new technology and automation is number two.
yeah, that's doesn't surprise me one bit. Okay, let's move on. We're almost finished here. Let's just look quickly at the long-term outlook for the economy. Clearly, the generation of economic growth is going to be challenging because of some of the issues that we just discussed. Demographic decline, and just like we just saw in that poll, the availability of labor is going to be a huge challenge for businesses and economies to grow in the future. But there are many other challenges as well: environmental, geopolitical, societal challenges all need to be overcome. Technology will be the key. Technology will be the make or break issue as far as the global economy is concerned. If technology can drive productivity growth, we can continue to grow. If not, we do face some serious challenges generating growth in the future. As you can see from that chart, which shows our average rate of annual economic growth, this is global around the world, we do expect the global economy, which has been growing about 3% per year over the last 4 decades, to slow. A lot of that growth in recent years has been because of the emergence of emerging markets, and their growth is slowing now. And we do not have another China in the pipeline. There's not another economy like that that can allow growth to continue, even as the world's rich countries grow at a slower rate. US growing about 2% per year over the next decade. You can see again right near the top as far as its performance or its forecasted performance among the world's developed economies. As far as emerging markets over the next 10 years, again, Asia, no surprise. What's notable, of course, is that China is growing by just more than 3% per year over the next 10 years. The slowdown in China will continue. The big question for the global economy is how big will this slowdown be? So what does this mean for the economy? We need to be more productive. We're going to be facing a world with less workers and in the future less consumers. We will be looking for new drivers of growth. New industries always emerge, new sectors always emerge. What will those be, and how will they help to drive the global economy forward? So finally, how do you prepare your business to succeed in what is undoubtedly a challenging global economic environment? Well, first, and that's what you're doing here today, is you're identifying the opportunities for growth for your business in the risks that could impact your business. You need to be on the first step is always understand where your business can grow and what are the threats to your business's success. Second, you need to have resources in place that when those opportunities arise, you're able to take advantage of them. Or when threats to your business suddenly arise, that you're able to mitigate the impact of those threats. And then finally, you need to have strategies in place to succeed in a challenging world. And this could mean working with experts both inside and outside of your company to have strategies in place to grow and prosper in the world of the future. So that's all for me. My email address is there, by the way, if you'd like to contact me with any questions you don't have time to get to now, but I know we've got some time for some questions. So I'm going to,
You, we
I'm
do.
ready to hear some questions. Fire away.
Sure. Thank you, Michael. We got some questions coming in through the chat from the audience. One of our one question here is, will repurposing employees that have been laid off from government and putting them into the private sector help the labor availability in your estimation?
It might in a couple sectors. For example, the tech sector, where there's a lot of government employees who are involved in the tech sector. Again, I don't expect there to be huge reductions in tech workforce in the government. I would hope not, because that's where we need to be driving government productivity as well. But that's one. But a lot of people in the government have very specialized skills. The people who've been let go, at least so far, and I do wonder how transferable some of those are to the private sector. So there's going to be an issue between the skills that become available to the private sector through government sector layoffs and how well they match up with private sector needs, particularly in a lot of the less skilled um, sectors of the labor force where a lot of our shortages are. I think there's a lot of the talk about labor shortages focuses too much on just the tech and high end of the skill level of the labor force, but we are facing in many parts of the U.S. lower skilled labor shortages, and I don't think we're going to be getting too much of that from the government sector.
Uh, Got another question from the audience. Do you know what the estimated chance of a recession was back in December compared to what it is today?
Yeah, it was around 10%. It was around 10, between 5 and let's say between 5 and 15%. So we'll average it at 10. And I just was looking up some numbers yesterday on this, and the major economists at the major banks, I would say the average now is between 35 and 40%. So we've gone from about 10%. There's always, you'll never see it at 0%, obviously, but it's gone up significantly. And the big concern for most of the economists is that dramatic drop in consumer confidence levels, particularly last month. That was a big warning sign. Now, typically, when consumer confidence levels fall and consumer spending levels haven't fallen in line, they typically lag a little bit. So the number to watch now is going to be, where does consumer spending come in over the next few weeks, what we see.
Sure.
And if consumer spending falls in line with the fall in confidence, then that number is going to go even higher.
We have time for one more question. Could you comment on the first quarter of 2025 performance of U.S. manufacturing? I know you speak to a lot of small, medium, and large businesses in the United States and across the world. What do you think the performance has been like in the U.S. for manufacturing?
I think it's been okay because a lot of manufacturers have been in quite frankly rushing to get to get things done prior to a lot of the tariffs either going in place. So I think the first quarter numbers are going to look relatively good. We just saw some numbers come out today on some manufacturing. We saw some manufacturing numbers come out today, which were on the upside, were better than expected. I do expect uh, the first quarter numbers not to look so bad. It would be if we would expect the manufacturing a downturn, it would be in the second and third quarters, and that would be in response to uh, tariffs remaining in place, particularly on Canada and Mexico, or new tariffs being introduced. But I don't think we're going to see a huge decline in the first quarter. I think numbers will surprise on the upside in the first quarter, just because a lot of people are expecting a downturn, but that downturn will not come yet because of this rush to beat some of these policy changes.
Right. Well, we're getting to the top of the hour and actually just got to the top of the hour. I want to thank you, Michael, for your presentation. It's very informative. I
Thank
know I've taken away a lot of information that I know will help me in what I do for manufacturing clients. I want to thank everyone for attending this morning and ask that you take the brief survey at the end of the presentation. As you close out, you'll be asked to take a brief survey. We appreciate your feedback. Presentation materials, the video, and CP certificates will be coming out shortly. So look for that in your inbox. Thank you again, everyone, and have a good rest of your week.
you.